Have you ever wondered how a single decision by the Federal Reserve can send shockwaves through the stock market, your investments, and even your daily life? Well, 2026 is shaping up to be a landmark year for interest rates in the U.S., and understanding this shift is more important than ever. Today, we'll break down exactly what this change means for your portfolio and how you can position yourself to thrive in a high-rate environment. Let's start with the big picture. The Federal Reserve has been carefully monitoring inflation, economic growth, and employment levels. After years of keeping rates historically low, signs now indicate that the Fed is increasing rates to combat inflation and stabilize the economy. While this may sound abstract, the reality is that higher interest rates affect borrowing costs, corporate profits, and even the way investors value stocks and bonds. Higher rates mean loans become more expensive. Mortgages, car loans, and business financing all start costing more, which can slow down consumer spending and business expansion. Companies that rely heavily on borrowing may see their profits squeezed, and that can lead to lower stock prices. But it's not all bad news. Certain sectors, like banks and financial institutions, often benefit from higher rates because they earn more from lending money. This creates a strategic opportunity for investors who know where to focus. So which stocks are most vulnerable? Typically, growth stocks, especially in technology, are sensitive to interest rate hikes. The reason is simple. When rates rise, the future earnings of these companies are discounted at a higher rate, which can reduce their stock valuation. On the other hand, defensive sectors like utilities, healthcare, and consumer staples often remain more stable because demand for their products is less affected by interest rate changes. Understanding this distinction is critical when deciding where to allocate your money. Bonds are also affected in a big way. Rising interest rates usually push bond prices down, which can hurt investors who hold long-term bonds. But this doesn't mean you should avoid bonds entirely. Strategic choices, like short-duration bonds or Treasury inflation-protected securities, or TIPS, can help protect your portfolio while still offering steady returns. Diversification across different bond types can also reduce risk during periods of rising rates. Cash and cash equivalents are another piece of the puzzle. While they often provide lower returns, higher interest rates mean savings accounts, money market funds, and CDS start paying more. For investors, this offers a safe and flexible option, especially if stock markets remain volatile. Holding some cash also gives you the ability to act quickly if new opportunities arise in the market. Now let's talk about timing. No investor wants to panic or make impulsive moves. A gradual, thoughtful adjustment of your portfolio is key. You might consider reducing exposure to highly leveraged companies while increasing allocations in sectors that perform well in higher rate environments. Remember, the goal isn't to predict every market movement, but to make informed choices that protect your wealth and maximize potential gains. Finally, keep your eyes on economic indicators. Employment reports, consumer spending trends, and corporate earnings will signal whether the rate shift is temporary or part of a longer-term cycle. Staying informed and proactive allows you to react wisely rather than being caught off guard. The 2026 interest rate shift isn't just a headline, it's a roadmap. By understanding the impact on stocks, bonds, and cash, you can navigate this environment with confidence. With a strategic approach, your portfolio can not only survive but thrive during this new era.